Hey guys, welcome back to the Wealth Creation series, the series where we talk about money and all things related to it and how you can generate more wealth for yourself. As always, I preface this video by saying that I am not a financial advisor or professional. This is simply things that I have found through my personal experience of trying to create my own wealth, and I give it to you simply as open-ended advice. Please ensure that you seek professional financial advice before doing anything that might impact your financial situation. So if you've been keeping up with the series so far, we spoke about why you want to be rich. We talked about removing your debts and how to get out of debt. We talked about savings and when and how much and what savings should be for. And in this last one of what we will call like the 101 series on wealth creation, we're going to talk a little bit about investing. Now, I am coming at you and I'm going to provide you with a very shallow amount of knowledge. I am not going to try in a 10-minute video here to explain investing to you in its entirety. It's not possible for a start. What I am going to do though is I'm going to make a YouTube recommendation. I recently connected with a great UK YouTuber called FiFi Financials. I believe that's what her channel's called, and I apologize if I got it wrong. But she does amazing videos on investing and on all things wealth creation. I'm going to link her in the description below. She's a smaller channel like myself and she's growing, so please go give her a subscribe. If you like me, I think you'll like her, and she's producing great content. So if you want to delve deeper into this and not wait for me to make videos, then she's someone who's already created a whole bunch of videos on the topic. So go check her out. Today, I'm going to talk to you as if you have no idea what investing is, why you'd want to do it, or how to get started. So if you have a baseline of knowledge, this might not be the video for you. But if it's something that you've always been a bit curious about or you've heard about, but you just don't know where to start, then this is exactly where you need to be. So to start with, what is it? When we're talking about investing, most of the time, what we're talking about is putting money into some form of asset that's going to pay you back. Okay, so I'm going to give you a real simple example that you will understand. Let's say you take the company Apple. Okay, Apple is a publicly traded company. It means that anyone is able to buy a very small percentage in the form of shares of this company. Now, when the company does well, the company pays out dividends and the value of that share increases in value. So if you bought that share, and again, I'm dumbing it down just so you understand. If you go online and you buy a share in Apple and you pay £100 for it, and the value of Apple goes up, they release the new iPhone and everyone's buying it, so the stock price goes up, your share increases in value. Now, Apple may also pay out dividends, which means, let's say the company makes a ton of profit that year. They take some of that profit and instead of just putting it in their pockets, they put it in the pockets of all their shareholders. So you will get a bit of dividends back to you, a bit of money paid back to you from Apple as part of their profit. Now, of course, if Apple do badly, the batteries in the phone start blowing up and the stock price goes down, the company's value goes down, you might have bought that stock for 100 and now it's worth 90, 80, 70. If the company goes bankrupt, disappears, your share in that company is worth 0, regardless of what you paid for it. And of course, you are no longer receiving dividends if they're not in profit, if they choose not to pay out a dividends. Does that make sense? That's the basics. Now, there's 100 ways to invest, and you hear people talking about investing in the property market. A quick example, you buy a house. Take your parents' house as a great example. They probably bought it 20, 30 odd years ago. It's increased in value. So if they sold that same house that they bought, they would make more money off of it than when they bought it. Now, some people don't buy houses to live in. They buy them as investments. They buy them with the intention of either improving them or holding on to them with the intention of then selling them on down the line. And you can do this with a lot of different things. Some things have more risk. So things like stocks, there's more chance of it having dramatic highs, but also dramatic lows. Things like you've heard of cryptocurrencies, Bitcoin. Bitcoin is famous for being very volatile. And by that, I mean, sometimes Bitcoin is way up here. And if you bought it down here, you've just made tons of money. But sometimes it very quickly, dramatically drops way down there. So if you bought it somewhere up here in the middle, it's now bombed right down. So that's the basic idea of what investing is. When you look at people and you hear about investors, you might have heard the name Warren Buffett. He's one of the richest men in the world, one of the most successful investors in the world. His main job, his complete thing that he focuses on doing is on picking and choosing certain companies and certain funds to invest in with the hopes of then making a profit. And when I say a profit and we're talking about investments, if you're talking about a really good day, we're talking 10%. We're talking about an okay good day, 3 to 4%. And if it's you're not crying about it, it's 1%, 2%. And of course, bad days, we're talking minus numbers. We're going the other way. So for someone like yourselves, and if I'm talking to you and you had no idea what all this is about, then you're talking about the very basic level of investing. My biggest advice to you is do not pick individual stocks and shares. So there's a lot of what's called platforms. Platforms is your kind of access to the stock market. So let's call our platform as trading. Okay, I've started a platform. I've opened a website up for you. You can log on to that website. You can create an account with your bank details. And in that website, you have the ability to buy stocks and shares in companies. As part of that, I'm going to take a very small percentage as my payment, or I'm going to do a transaction fee. So every time you buy a stock, I'm going to add a little fee on top of it. 0.2% of whatever it is, 1%. I'm going to add a little fee. That's how I get paid as trading, the company. I suggest for you that you don't go out there and try to what's called time the market. So what I mean by this is I don't want you to go out there and go, oh, Apple's done really bad. Those batteries blew up last month. I'm going to go buy loads of Apple stock now because it's low. And then I'll sell it when the new iPhone comes out and make money. The reason I don't want you to do this is because timing the market has been proven to be a very ineffective way of making money. Effectively, what you're doing is you're gambling. That's effectively what it is. You can think of it like you look at a boxing match. One guy is the champion. He's been the champion for 10 years. The other guy, it's his first time at this level. Okay. You put all your money on the champion because you're just so sure that he's going to win because all the information shows that he's going to win. But the other guy gets a lucky punch, knocks him out, and wins the fight. And you've lost all your money. It's very similar. It's very easy to look at the stock market and predict what you think is going to happen. But very rarely are you going to get it right. Sometimes you will. And just like sometimes you'll place a bet and you will win. But sometimes you won't. And what it is over the long term, which is how you want to think of investments. And by long term, I'm saying 5 years plus. Are you going to benefit from that approach of sometimes winning, sometimes losing? It's a very high risk game, okay? And if you lose very early on and you lose all your money that you put aside for investing, then you're kind of lost at the start line. You're not going to go anywhere. The other way of investing is investing in, and we're still talking about the stock market, in multiple companies at once. And this would be what's called investing in an index fund. So you might have heard of things like, and my brain has gone completely blank, the something 500 and all of these index funds, which are basically a collection of the top 100 or top 500 companies in, let's say, North America, let's say Europe, let's say the world. Okay. And this collection of funds is then a reflection of their collective stock price. And this is where we talk about a word that comes up a lot in this, which is diversity. Diversifying, what was that? Diversifying your portfolio to minimize risk. If you just invest in Apple, your money is reliant on whether Apple does good or whether Apple does bad. If you invest in Apple, in Tesla, in Nike, in McDonald's, and your money is spread between those four that's what it was for. And your money is spread between those four companies, then if one does bad, but two do good, and one doesn't really change, then you've done good. If all four do bad, you do bad. But what's the chances if they are diversified enough, if they're different enough, what's the chances of that happening? Far smaller than what it would be if it was just one company doing one thing. An index fund allows you to buy in on a much smaller scale to a much larger pool of companies or of things, because it might be diversified in the sense of it's partly in gold or it's partly in certain industries. You can get very, very specific, or you can get very, very broad. S&P 500. Sorry, my brain blank just came back and I fixed myself. So when you want to get started with investments, this is a far lower risk way of entering into the market. You can invest, and over a long period of time, 5 to 10 years, you can expect to see a healthy return on your investments. We're talking 5 to 10% annually. Now, of course, we know what's happened in the world this year. Everyone who is invested in the stock market and had not pulled their money out before it all happened saw a dramatic loss in the value of their funds. And this is the important thing about understanding that investment is for the long haul. It's not something that you should be looking at as, I want to make £1 million in the stock market this year. It's not realistic. It's not achievable. There are people whose full-time job, Warren Buffett's full-time job, is figuring this stuff out, and sometimes he gets it really, really wrong and loses millions and millions of pounds. So if he, with all the information he has access to, all the resources, and he still gets it wrong, what chance do you have with Google and your mate who says he knows something about what's happening over at Google this week? Okay? Use index funds if you're going to get started. It's a great place to get started. Like I said, please check out FiFi Financials or FiFi Finances. I really apologize. I should have double checked your YouTube name before I go recommending you. But she's an amazing channel, and she's a small channel, and she's a UK-based channel like myself. So I'm very happy to support her, and her information seems spot on. I'm going to do more videos like this. I'm going to cover a lot more of this information and knowledge. But I just think if you want to get a head start on stuff and not wait for me to make the videos, she's there. Give her a follow, give her a subscribe. Tell her that I sent you, because I know she'd appreciate it. And as always, guys, I'm going to follow up on this one. But take care of yourselves. Get started. Before you do anything, ensure you seek financial advice. Ensure that you've cleared your debts. Ensure that you've got your savings in place so that you've got a backup should things go wrong. And then get started investing as soon as possible. The big thing with investing is not to time the market, but it's your time in the market. One of the big reasons Warren Buffett is so successful is he started investing when he was a kid. He's been in the stock market for so long that he has survived all the peaks and valleys, and over the long term, things have gone up. So a lot of his value was made very early on, and it's the power of compounding, which I'm going to talk about in a future video. As always, take care of yourself.